Time to talk about the currency market, the dollar specifically, weakening today to the lowest level versus the yen in a month. It fell also against the euro as the Federal Reserve said that low rates could fuel speculation. Michael Woolfolk, senior currency strategist at the Bank of New York Mellon, joining us now from New York to discuss his outlook for the dollar. Michael, good to have you back with us. Let me start by asking you to give us some perspective on the dollar's decline. I bring that up because some folks have said, you know, the decline we're seeing this year is not as bad as some declines we've seen in the past. How bad is the decline that we've seen in the dollar index? I think it's down about 7.6% this year.
Well, certainly the dollar is weak. It's at the same level versus the euro that it was back in January 1980, the synthetic euro, of course. The euro was launched in 99. The average rate has been since then about 1.17, close to where it was launched back in 99. It's not surprising that the dollar is at the weaker end of its range compared to the major currencies, given zero interest rate policy. So I don't think that we should necessarily look at this as a crisis for the dollar. We've seen some stability in the U.S. dollar here recently. In fact, the U.S. Treasury has indicated that we had a net inflow, once again, of U.S. dollar deposits and short-dated securities from overseas in the month of September. So the outflow that we've seen over the past year or so in the wake of the financial crisis from the safe haven dollar bet, that seems to have come to a close. So one of the three factors undermining the dollar no longer exists right now. We still have low interest rates, and we still have the dollar used as a funding currency, which will continue to drag the dollar down. Let me ask you something, though, Michael. So is it too simplistic to say that eventually we're going to see the Fed start to raise rates and that will support the dollar and the dollar will turn around? Is it that simple? It's a very large part of the equation. The longer that the Fed delays raising interest rates, the longer the dollar carry trade will build, and the reversal will be increasingly larger. If, as the market believes, the Fed is not going to raise rates until well into next year, let's say the second half of next year, we could see, once they begin raising interest rates, a 10% correction in the U.S. dollar, which would be in the order of disorderly conditions. We would prefer to see a more gradual process.
Hey, Michael, but we've heard James Bullard say maybe not even until 2012. I guess that's kind of taken out of context, but you can see the case, right, for rates staying this low that long. Is there any scenario under which you do see the dollar snap back up? Because with so many people on the short side of the dollar trade, it would obviously cause a little bit of a catastrophe, wouldn't it?
Well, I think that if we see a perpetuation of current trends, continued rise in the value of global equities, we continue to see the dollar fall, I don't think that we have to get into 2010 very far before the Fed starts talking about higher interest rates. And I think that once we clear the hurdle of Ben Bernanke's new term in another month's time or so, I think it's going to be a completely different picture. Right now, it's very politically unpopular to talk about raising interest rates when you're going up to Capitol Hill to get reconfirmed. You know, Michael, those FOMC minutes today, the Fed members, the FOMC members said they saw the decline in the dollar as orderly. Is it orderly in your view? Yes, it has been very orderly, I think, particularly given the fact that we're under pressure of a carry trade, zero interest rates. It's been very orderly. Over the last several trading sessions, in fact, we appear to have a very nicely defined trading range with the euro dollar between roughly 148 and 150. The market feels comfortable with that, and we have not had any sufficient catalyst in the last several trading sessions to prompt us to move outside of that range. I think the Fed feels comfortable with that, and traders feel comfortable with that. We need a new catalyst, and we're not going to get that, I think, until at least the next week after Black Friday.
What about Jean-Claude Trichet? I mean, does he find this to be orderly, or his Asian counterparts? I mean, at what point does dollar weakness start to kill off recoveries in other economies?
Well, I think that case has certainly been stated by Trichet, by Mark Carney in the Bank of Canada, even Mervyn King in the UK. Foreign central bankers are very concerned now about strength in their own currency as they've been relying on exports for growth. And certainly a strong currency undermines that ability to export. I think that argument really has been overplayed because it's more global recovery that will create demand for their product, not necessarily a 5% move in the value of currencies. So I think that, if you listen to Trichet, he would say that now the dollar is in not just the U.S., a strong dollar is not only in the U.S. best interest, but in the world economy's best interest. That was a statement he made yesterday, which I think is very telling.
So, Michael, when do we start to see a strong dollar?
Well, I think, again, the Fed begins signaling early next year after we clear the holidays, and
okay.
we're likely to get
We got to run. Michael, thank you.